Well, stocks do typically perform better in the wake of cuts from the Federal Reserve. My next guest has a playbook for how ETF investors can potentially take advantage of any post-cut bump. Marissa Ansell, Goldman Sachs Asset Management, head of ETF investment strategies, joining me now on set for this week's ETF report brought to you by Invesco QQQ. Marissa, thanks for being here.
Thanks for having me.
So I guess, first of all, to set the table, we should talk about what the Fed is going to do today and what we're going to hear from them. 25 basis points, a quarter point cut is what's broadly expected. The other things that Jennifer was talking about, kind of the signals for what's next. What are you looking for and expecting?
Yeah, so our base case expectations are, again, in line with consensus, 25 basis point cut today. We expect another couple of 25 basis point cuts through the end of the year, followed by another couple in the first half of next year. But what we're really focused on is helping our clients position their portfolios in this new environment. And I think there are a few simple things that clients can do to help position for this. Number one, step out of cash and consider ultra short duration bond strategies. Number two, focus on income. And I think the equity market can actually be a great source of income with derivative income type ETFs. And number three, consider small caps. With rates coming down, that's a really nice tailwind for the small cap asset class. And we think that there's a pretty nice setup for small caps from here.
So let's take those one by one.
Sure.
So in the first, to step out of cash and into ultra short bond ETFs, sort of what's the big difference between those two? Because I sort of think of them in a similar bucket.
Exactly. And I think that's how a lot of investors think.
Yeah.
But I think what they can do is, to the extent they have either cash holdings or money market fund holdings in their portfolio, they're going to be earning even less interest, of course, with rates coming down. And so, to the extent that investors are saving, let's say for next year's family vacation, right, so they don't need access to that cash for the next 6 to 12 months, a good thing that they can do is actually go one step out into ultra short bond ETFs like GSST, which is our ultra short bond ETF, or GUMI, which is our ultra short municipal income ETF.
Gotcha.
Because you can lock in higher yields and really pick up sort of 30 to 40 basis points or more of additional yield.
Okay, you're saying ultra short. I heard in my brain ultra short term, like short time duration. You're talking about actually shorting the bonds. So that makes...
Oh, no, going long the bonds, but with ultra short duration.
Okay, it is ultra short duration.
Yes.
Okay, so I did understand it correctly. Okay, good. Let's talk about the income part of this here. Are you focusing on sort of dividend payers as a source of income? You mentioned derivatives. How does that all work?
Right. Yeah, so I think, with yields coming down, putting, pressure on yields in traditional fixed income investments, again, the equity market can be a really great source of income. And this year we've seen derivative income ETFs be a huge flow gainer. $44 billion have flown into derivative income ETFs like GPIX, GPIQ, our premium income ETFs. And the reason why is because they help investors solve for several challenges. So they provide equity exposure, but with less volatility. So, that's ideal in the current market environment. But they also pay out, high, consistent, regular income, which is great for investors looking to solve for their income needs.
Gotcha. And then the small caps, which I would argue is probably the most controversial of the three, because we've been hearing some investors beat the drum on small caps for a while now, and we have not seen them come back.
Yeah.
So is it rates are going to go down and this is it?
So I don't think that's it, but I think you're right. Small caps have been playing a little bit of a waiting game, so far this year, right? Because they've been waiting for the Fed, I think, to cut interest rates. I think that's a great backdrop for the small cap asset class. They do have more floating rate debt, so they're going to benefit more than larger caps from, as rates come down. But in addition, we think the setup for small caps is actually really attractive from here for a couple of key reasons. So number one, fundamentals are really good. They're really solid. Small caps are set to grow their earnings by 30% next year, vis-a-vis 10% for large caps. Number two, IPO and M&A activity has picked up in a pretty big way, actually. M&A volumes are up 30% versus the same period last year. The number of IPOs is up more than 50%. Year on year. So that's a really nice sort of catalyst for the space. And then number three, and this is sort of the kicker, valuations are actually still incredibly attractive for small caps. So the median small cap company is trading at a 27% discount to large caps. And so, putting all that together, you've got this tailwind of the Fed now finally starting to cut rates. You've got a really nice setup, I think, for small caps from here.
And do you want to buy small caps in toto as an asset class, or do you want to sort of screen out more profitable companies, through an ETF process? How does that?
Yeah. I think definitely the latter. You really don't want to buy the whole benchmark, particularly in small caps. And the reason why is because about a third of small cap companies are actually loss making.
Right.
And so it's really, really important to go active. We're an active manager. Our small cap ETF, GSC, is actively managed. I think it's really important to focus on the best companies, focus on fundamentals, as well as valuation.
So I'm curious, these are sort of 3 changes that you're recommending people make. Is there also sort of a big stay the course theme through the rate cutting cycle?
There is, yeah. History actually shows us when we look at the data that the best investment strategy over time has been to stay invested rather than trying to be sort of too cute and time the market. I think that's incredibly difficult. And so we're recommending to our clients, stay invested, but at the margin, there are different tools that can be really useful for this environment, such as, stepping out of cash, considering small caps and focusing on income.